Hi there, it's Bill with Smart Trades, and it's Tuesday, November 30th, around 10:50 a.m. Pacific time. Going to do a bit of a review because not a whole lot has changed since my last report. We have had some, a little bit of movement to the downside, but all in all, we're still basically locked in a range. And that range is bound by a couple of fourth waves, at least according to my count, which of course may or may not be correct. But we had a triangle fourth wave, and that area, the termination of that basis, the 24-hour futures was around the 1173.50 area, and as noted here. And as you can see, we've been finding support there over the past 2 weeks or so. And in addition to that, my labeling of the decline includes a fourth wave back also about 2 weeks ago. And that area has been providing resistance. And indeed, I was looking for a possible slightly higher price above wave A to test that fourth wave resistance and then a decline. It still remains to be seen whether or not we're going to get that. And indeed, here is the cash count. Again, here's that support, previous fourth wave support on the cash. It's around 1177. And once again, we're finding support there. In this count, however, we are counting this as a possible failed C wave. In other words, it did not take out the high of wave A. To be honest, I'm not sure if that is indeed correct or not, if this is a completed ABC. One problem with that is that the breadth ratios on the rally have been quite strong, and generally speaking, when you get that, you get a retest of the price high that occurred when the breadth ratio was strong. So the implication of that is that we're probably going to go back up. And there's no guarantee that we're going to stop at this fourth wave resistance, which on the cash comes in around 1207 or so. But that would be the area to look for next, if indeed a top is in. And I'm far from certain that one is. Once again, one of the key areas is the 1218.75 area. It's key for a variety of reasons. If we had a failed fifth, that would be the start of this impulse down, and one of the basic tenets of Elliott is that you cannot exceed the start of a wave one, so that would invalidate the top according to this scenario. And here is that count that I mentioned before: A up, B down, holding at that previous fourth wave support, and then a C that would go back up and tag the smaller degree fourth wave resistance, and then we're going down. Again, let's take that one step at a time, because there are some cross currents in this market, to say the least. Here again, here's that breadth ratio on the NASDAQ, and these are all very strong. They actually made new highs over the last month or 6 weeks or so. And again, the implication is that we're going to go back up and test this area. Also, if you'll note on the NASDAQ, I think this best counts as a corrective pattern in both directions. So, potentially what we have, and one of the reasons that we're range bound, is we have an ongoing correction of somewhat larger degree than what I've got noted here. So in other words, this perhaps is our A down, and we're still working on a B back up, or perhaps a triangle or something of that nature. On the bearish side, Google had a very clear impulse down, which I noted previously, and then bad news overnight from Europe, basically knocked Google right below support. Now, there's a tendency for Google to lead the broader market. So again, here's that bearish scenario where we have a failed ABC, and then clearly an impulsive looking decline to new lows in Google. So once again, we have very definite cross currents in these markets. Some of them, like Google, obviously are bearish, and then, for example, here's the Russell futures, and you can see the impulsive patterns to the upside, the clear corrective patterns to the downside, and it has outperformed the S&P and the NASDAQ. And perhaps, again, this is a B wave up here, A down, B back up, and part of a larger correction. Again, too early to tell, or perhaps we're going to go up and make new highs. It's to be honest, I just am not sure about that. The count here is not clear. On the euro FX, now this has been definitively bearish over the past several weeks, and here again is our fourth wave. That's the same triangle that basically formed in the stock market. However, in this case, the euro broke right through it. It found support very briefly, and what's interesting here is that the basic tenet of Elliott is that a market should find support in the range of the previous fourth wave, ideally at the terminus. Now the terminus is right around that 138 area, and indeed we found support there initially but broke through pretty quickly. Then that area became very precise resistance. So another way that you can use that fourth wave terminus as kind of a demarcation point, if it gets broken, it's telling you something, and in this case it was telling us that the euro wanted to go lower, and indeed it gave us a relatively low risk sell point when the euro tested that previous fourth wave apex as resistance. Gold, on the other hand, it can be counted as 5 waves down, and it's broken back above its fourth wave resistance. That said, it's paused a bit here right at a 62% retracement. It's certainly possible, again, to count this as 5 down. This rally back up can be counted as corrective. The volume is reasonably light. Again, we've paused right at the 62% retracement of this entire decline. It wouldn't shock me to see gold go up to, say, the 1400 level, even if it is going lower. A rally through the top of this channel, though, probably indicates that new highs are coming. And a rally through 1427, the old high in the beginning of this impulse down, breaks the bearish pattern for gold, at least in the short term. And finally, here's a review of the very long-term picture on the Dow, basically going back to year 2000, which I'm counting as the top of the bull market. Now, I don't have all the labels in here, but suffice to say this is A down, B back up, C down, and I'm calling that A. We had a previous discussion online, and some folks are saying that this rally from the 2002 low is impulsive. I disagree with that, and it can be counted as impulsive in this way. You can count it 1, 2, 3, triangle, fourth wave. However, here's the problem. When you count off of the apex of the triangle, it counts 1, 2, 3, 4, 5, 6, 7. Well, 7 waves up is a corrective pattern. It's not impulsive. So I think, although it's not impossible to find a few little wiggles in here to change that count, I think this best counts as a pair of zigzags separated by a triangle X wave. And you'll note that these two legs up from the 2002 low to the 2007 high are approximately equal. Whether you're looking at an A equals C or W equals Y, it's the same basic theory that two legs of a corrective pattern will tend most likely towards equality. So I think that the rally from 2002 to the peak in 2007 best counts as a corrective pattern, and therefore in this context a B wave. Okay, now one last thing. Assuming that we do break out to the upside, which I don't favor at this point, but it's certainly something that we should look at, because the market is hanging in there, and the Russell is indicating that we are going to make new highs. The next target basis, the Dow, comes in approximately around 12,600. That would be a 62% ratio of the A wave back up. Also of note here, an A equals C from the 2009 low would actually produce new highs. That's important because that breaks the ultra bearish count entirely, at least in terms of the way that they've been counting it basically since 2007, and probably indicates that that indeed we are into a very large sideways pattern or a whole new bull market, possibly. I don't favor that at all, but you know, anything's possible. Anyway, the bottom line is, you know, if we do rally from here, the next resistance, if we do make new highs and they're confirmed by good breadth ratios, 12,600 on the Dow. These targets actually don't fit too badly, or I should say they fit well, even if we go back down, as I've expected, to around the Dow 9,000 area. In other words, we have an A, B, C down, and then our larger C wave would take us up either to that approximately 12,600 level or back above 14,000 in completing this larger B wave to the upside. Anyway, that's probably more than you want to hear for now. Hope you're having a great week. We'll talk to you soon. Bye-bye.